$1,330 in 3 trading days on a stock that first dropped nearly $9 against us before we ever saw a green day. This is the ISRG Long Call trade that could have been a stressful loss, and instead became one of the cleanest setups of the year. So what did we see? What did we sit through? And when exactly did we pull the trigger to close? Here are the exact numbers. We bought 2 contracts of the ISRG August 28 expiry $300 strike long call at an open price of $48 per contract. In options math, that is $48 times 100 shares times 2 contracts, $9,600 total capital at risk. That is your maximum loss if ISRG somehow went to 0 before expiration, which was never a realistic scenario with a stock this large. Break even on the trade at expiration was $348, the $300 strike plus the $48 premium paid. But because we were deep in the money and trading with a very high delta, the position started behaving almost like owning 200 shares of stock. Max gain? Theoretically unlimited, as long as ISRG kept climbing. We didn't need a miracle. We just needed the stock to hold above $348 and push higher. Here is what you are looking at on the chart. Entry on July 22nd at $340.69. The very next session, July 23rd, the stock dropped hard, opening at $338.50 and closing at $332.02, touching a low of $328.57. That is an $8 drop in one day. July 24th offered a partial recovery to $337.50. Then on July 27th, our exit day, the stock opened at $344 and ripped to close at $356.83. That is the move we were positioned for, a $16 reversal from the trough to the exit. After we closed at $356.83 on July 27th, the stock did not stop. The very next session, July 28th, ISRG opened at $365.50 and closed at $361.80, reaching a high of $374.70 intraday. Did we leave money on the table? Absolutely yes, but that is the honest answer anytime you close a winning position before expiration. The exit was disciplined, the profit was real, and chasing the last few dollars is how clean wins become complicated ones. We took the $1,300 and walked. Here is the real lesson from this trade, and I want you to sit with it. The trade went against us almost immediately. On July 23rd, one day after entry, ISRG had dropped more than $8 from where we bought. On paper, that hurts. In practice, what separates a profitable trader from an unprofitable one is not the ability to pick stocks that go straight up. It is the ability to distinguish between a trade that is wrong and a trade that is just uncomfortable. This one was uncomfortable. The thesis, strong earnings, institutional buying pressure, a deeply liquid stock with structural tailwinds, had not changed. The support level at $342 was broken intraday, yes, but there was no fundamental deterioration. If you had closed on July 23rd out of panic, you would have locked in a loss and missed a $16 recovery in the stock within 4 days. The long call structure helped enormously here too. Because our risk was capped at what we paid, we were not getting margin called, we were not spiraling. We simply had to decide, is the thesis still intact? It was, and we held. Now, did we exit perfectly? No. The stock ran another $15 after we closed, but a $1,300 profit in 3 trading days on a defined risk trade is not something you apologize for. That is the sensible trade for this week. If you found this breakdown useful, follow us on Twitter for daily trade insights and the latest episode drops. Every trade, the good ones, the ugly ones, has something to teach you. Keep showing up, keep learning, and we will see you next week. Visit thesensibletrade.com for more details and resources. That's thesensibletrade.com.